I've been investing in real estate since my early 20s, and although I run a mortgage shop and I structure a lot of deals for a lot of different clients, in the base of it all has to do with real estate. And so whether it's for myself or for clients, I can tell you that I've seen a lot of moving pieces and people building a substantial amount of wealth through different investment components that I always enjoy sharing with you on my channel. Now in this particular video, I want to talk to you about 5 key pointers of you being able to maximize wealth by going through and using real estate as a vehicle to make money. So if you're trying to capture that information, I think you're going to get a lot of value from this video. So with that, let's dive right into it, all right? So number 1 on my list is wealth multiplication. And basically what this is you being able to leverage the value of real estate to generate a much higher return on your investment. And let me explain this to you in everyday terms, because I feel like if somebody has $50,000 and the first thing they think about is locking it up in a CD at the bank. Now, nowadays, February 2024, these type of investments, to my knowledge, hover somewhere around 4.5% to 5%. So say I was going to inject $50,000 into a CD account and lock up my money for a period of 6 to 12 months. Likely, if I put in $50,000 and I made a 5% return, I would generate about $2,500 for the year. Now, while that's not bad, considering that a couple years ago rates were a lot lower, and then being able to get a decent return on your money at the bank is virtually non-existent, if you actually took that same $50,000, assuming you could afford to buy yourself $1 million house, that would actually be a 5% down payment. Now, historically, real estate has appreciated 5% a year, which means that if I put down $50,000 and buy myself a primary residence for $1 million, and that primary residence just follow the traditional growth of real estate, which is 5%, I would actually make $50,000 at the end of the year. So while $2,500 is a nice return on my liquid funds, by locking it up into a primary residence, I can actually make 20 times more. Just something to keep in mind, and that's basically how you can multiply your wealth through real estate. And the truth of the matter, most of the millionaires in America, a lot of them, have made their wealth through buying real estate, and a lot of it has to do with this type of structure. Now, that's example number 1. I'm going to go to number 2 on our list, which is actually a tangible asset versus liquid funds. Remember, I talked to you about locking up that money for 6 to 12 months so I can get that 4.5% or 5% return on my money. Now, what if I didn't want to lock up my money at all, right? That would be considered then a low yield investment, whereas I'm putting my money into a savings account. Now, the moment I do that, I don't get the same premium return as I do in the CD, and I probably would be lucky to make 1 or 2% on my money. So if I'm going to look at it that way versus a long-term benefit of me using my money for equity growth, tax advantages, or hedging inflation, let's assume that again I took my money and I bought real estate with it. Now I have the appreciation of the property that we've discussed. So now my money is growing significantly more. In addition to it, there is other things that I can write off. Now, I'm not a CPA and I can't give you tax advice, but you could actually write off your mortgage interest, which is another benefit, something that, hedges your income. What about when, we've gone through this massive wave of inflation, which has really been the big issue as to why interest rates have gone up, right? The Feds is trying to cap inflation, and so they're raising interest rates to slow down the economy. What happens when you own real estate in inflationary times? So the costs of real estate continue to go up while the cost or the value of money goes down. So imagine this. Say I have $100,000 in the bank, right? And so if inflation is taking place and the cost of goods now is more, that means that the value of this 100,000 keeps going lower. Meanwhile, if the cost of products go up, including real estate, then my real estate goes up and the value of my money goes down. Pretty incredible, right? So that by itself is comparing tangible assets, which is in fact, buying a piece of real estate, it's tangible, you can touch it, to just having liquid funds parked in something like a savings account. I personally wouldn't recommend it. It's not something that I've done with my money, but that's definitely something to think about. Number 3 on our list, I want to talk to you guys about leverage strategies. What is leverage strategies? So you can actually amplify returns by using borrowed funds. Now you see a lot of investors on social media, specifically people like Grant Cardone. If you're watching this, you might be familiar with who he is. Somebody who basically took everything that they have at some point in their life, sold it, and invested it into real estate. And luckily enough, it went up in price and he made a fortune with it. That's how he was able to retire and start doing whatever it is that he's doing for a living. Now, the thing is, when you buy a primary residence specifically, and I'm going to use this example because it's the largest leverage that you could possibly get. You could actually leverage as much as 97%, meaning you have to put down a 3% down payment when you're a first-time home buyer, and the bank will finance 97% of the purchase. That's pretty crazy because no one would ever give you that kind of money. No one will ever tell you, go buy something and you put down 3% and I'll basically leverage 97% of it, because there's no security for the lender. That's why you can only do it as a first-time home buyer. So picture this. If I'm able to buy property again for $1 million and the property moves 5% a year on a normal year, that means that after the year is done, I now have $50,000 more of appreciation or equity in the property. That's me being able to build wealth. And the only way I was able to hold on to that $1 million property is by putting down my, let's just call it 3 to 5%, which is $30,000 to $50,000. So I was able to make $50,000 by putting in $30,000 to $50,000. That's pretty amazing if you think about it. And you have that opportunity in real estate. You have that opportunity in other investment vehicles, which I don't know as much about. I know you could do it in the stock market on margin, but it doesn't seem like a very safe investment to me. I know real estate, and real estate is something that's tangible. It doesn't go away. It's not a speculation. It's not a company that has to present earnings and then the market rallies as to whether they like it or not. Values tend to be pretty stable and historically have gone up about 5%. So when you're looking at comparing leverage, in any type of an investment, I think that being able to buy up and simply hold a loan against something that's worth so much more and take advantage of the upside, which is the value, is a huge plus in being able to own real estate, all right? Now, number 4 on our list, that's interesting, is income generation. Now, we obviously all go to work because we have to make money, but what happens when you buy real estate and through the years, you're able to up your rents? You get to a point where if you own multiple pieces of real estate, and not only does the income from the property cover what you call PITI, it's principal, interest, taxes, and insurance, which now means that you have a built-in 401k. And the reason is because you're at a point now where that balance is getting paid off by rental income. But in addition to it, you have something called cash flow, which is the delta, the difference between the actual expense to the cash flow, the money that you make every single month. And now the crazy thing is with real estate, every single year that delta will grow because you're able to increase the amount of rents that are collected from the property. So if you actually have a tenant in a property, you could actually increase rents on an annual basis of anywhere between 3 to 10%. Pretty substantial, especially if you own a bunch of real estate, 10 years go by. Imagine what that could do to your financial freedom. Now, something for a different video, not this one in particular. I do believe that you need 2 streams of income to be able to invest in real estate, which is your active stream and your passive stream. But we'll save that for another video. I do want to talk to you about number 5, which is diversification. Now, I've never invested much in the stock market, and the reason I haven't done so is simply because I knew that even if I have $20,000 or $30,000, in the best case scenario, I would actually double my money. For me, that wasn't good enough. I knew that if I take that $20,000 or $30,000 and I plug it into a down payment, and the property goes up 5 or 10%, I will make so much more than $20,000 or $30,000 that for me, it was a no-brainer. Now, it really depends on what stage of life you're in, because a lot of people, they don't want to sit around and wait for appreciation. They actually want the cash flow straight up, and that's perfectly okay. You could do that. However, if your whole portfolio is based off of stocks and bonds, then I would say that more than likely it's more risky than just having some diversification into real estate, because in my opinion, real estate has been pretty stable, and moving into the future, I don't think that that's going to change a whole lot. I would be curious though to find out what you think about this type of a blueprint. We discussed the wealth multiplication, which is basically the real estate being able to generate leverage and higher returns, right? I used an example of if I had 50,000 and I got 5% return, it would only be 2,500 versus investing it in a primary residence that could probably yield me $50,000 a year. We discussed the tangible assets versus liquid funds, which is again buying tangible assets like real estate versus just parking it in a savings account. Clearly you'd make a lot more money, and there would be other benefits that are attached to it. We've discussed that. Leverage strategy, how I can amplify my return by borrowing money. So I can actually go out there and buy something a lot bigger. It's gonna make me a lot more money every single year simply by putting down a little down payment, and the person who's gonna leverage it is the bank for me, especially if I'm a first-time home buyer. Income generation, how I could potentially replace my income by buying enough real estate, waiting over time for rents to go up. It's a twofold method because, like I said, one side of it, I pay off the real estate, principal, interest, taxes, and insurance, building my 401k. The other piece of it is my income piece. Anything above and beyond is my cash flow. And lastly, being able to diversify, staying away, well, I wouldn't say staying away, just being able to diversify, not only by stocks and bonds, but tangible assets like real estate, to have, a nice big portfolio of both stocks and bonds and real estate included. So I hope you've enjoyed this video. If you have, please drop me a comment. Let me know what you learned. Let me know what you think about this. If you do like the video, please hit the like button simply because it will tell Google that this content is relevant to viewers like you. It will help the video get some traction. And lastly, if you enjoy this content, then please subscribe to the channel and you'll get more similar videos to this in the future. I appreciate you so much for being here. Thank you. You're awesome. And I look forward to seeing you again on the next video. Thank you for watching this and take care.